Our next guest says he's figured out why the financial system came close to collapsing, and he's got some ideas about how to fix it. But there's another reason you want to hear what Gorton has to say. For 10 years, he was a consultant to AIG Financial Products. That's right, the derivatives unit that brought the insurance giant to its knees. Gary is professor of finance at Yale University. He joins us this morning from the Yale campus in New Haven, Connecticut. Gary, thanks for being with us. Let's start with this. You know a lot about credit default swaps, the contracts that effectively sank AIG. You helped AIG build the computer models it used or didn't use particularly well to manage risk. And as you know, those same contracts are at the center of the controversy that flared up in Congress last week over the AIG bailout. And because you're so familiar with them, I want to ask you, who's right here, Neil Barofsky or Tim Geithner? Did the government really have to make the AIG counterparties whole at 100 cents on the dollar?
Well, let me start by saying I don't have any direct knowledge of exactly those incidents. I think there's probably a lot to be learned. So I'm sorry I can't shed much light on it.
All right, no problem. AIG's models, as you know, weren't the only ones that failed. The same thing happened in long-term capital management. Is Warren Buffett right that we should beware, as he says, of geeks bearing formulas? Have academics like yourself got into a bit of hot water given the experience that we've all lived through with the financial collapse?
I don't know the answer to that. I mean, I would debate with you about whether something went wrong with the models. It's not clear to me that anything did go wrong with the models. I think it's impossible to turn back the clock, so everybody's going to have to learn from this, and hopefully things will be a little bit better going forward. But I don't think the financial crisis happened because of anybody's models. I think the financial crisis happened for the same reasons that financial crises have happened in this country periodically for hundreds of years. And in fact, the period from 1934, when we got deposit insurance, until the current crisis, that's the period that is really, really unusual. Prior to 1934, it was rather a regular occurrence to have these kind of major crises. So there's something bigger, something structural, something fundamental, which is the issue. And a lot of these other things are not really issues. I mean, keep in mind that AIG, like Bear and Lehman and many other firms, got into trouble when asset prices fell. They didn't cause asset prices to fall. So the question really is, what caused asset prices to fall? And remember, it was all assets, not just subprime related bonds, but bonds that were completely unrelated to subprime fell in price. That's really the question.
But, I mean, Gary, isn't the idea that the professionals, the people who are working in these fields are prepared for asset prices falling and asset prices rising and also asset prices staying the same?
Well, I think it's very easy to be a Monday morning quarterback. I don't know anybody who thought that we were going to be in a situation where we had a major collapse of the financial system. I think, if anything, everybody on the planet was of the view that this was something which was a thing of the past. And the shadow banking system, as it's called, didn't develop overnight. It developed over 25, 30 years. And it's something that was just not very well understood. So, of course, looking back, it's possible to point fingers at people and models and so on. But the question is, what do we need to know to understand to keep this from happening again? And I think at this point, we've had several years of recriminations and witch hunts, and it's not been very productive. It's time to be a little more dispassionate, I think, and try to figure out what happened.